unfortunately, with the events and the situation that we're all dealing with regard to COVID, we haven't been able to effectively do a webinar in the last couple of months. But it certainly is our desire and hope to be able to put on these webinars for all of our clients, and bring on special guests to talk about things that are happening within the industry, not necessarily from a regulatory perspective, but areas from a strategies perspective for all of you guys that are managing and operating registered investment advisors. So today, as I said, our sole goal here is to talk about and inform all of you guys around the investment due diligence process, what regulators are taking into account during the SEC exams or state exams that we've been managing through with our various clients over the last year. And this is all coming on the heels of the investment advice reform and the Reg BI Act that came into to action last June. Many of you guys that we're talking with who are SEC registrants will have heard from us with regard to Form CRS. That is the installment for registered investment advisors for their ADV Part 3 to be effectively filed with the commission and presented to your clients. Again, it's at the onset of the Act for our SEC registrants and a few state registrants that have this requirement. But it really goes a little bit further than what the Form CRS plays out there, and what you'll hear today from Jennifer and Barry, from my perspective, is a lot of feedback and what we expect that the regulators are looking at for investment advisors, particularly in the realm of the investment due diligence, the recommendations of the investments and securities and holdings that you're making to your clients. What level of due diligence needs to be put in place, and how thorough that needs to be, and we'll provide some kind of takeaways there. So with that, Barry Mendelson is with us, as I said. Barry, any initial thoughts that you'd like to share with the audience?
No, other than to say, I don't think that the changes which have taken place in the Investment Advisor Act side are substantive and material in the sense that the act has been changed. But I do think that what's happened is the regulators are saying we are going to be examining things much more closely. And there was some clarification that the Act provided, the changes to the Act provided, but it was more clarification than it was a real change to the Act. But in my point of view, from my point of view, I think it was the regulators saying, fair warning, everyone, we're going to be looking at things much more closely in certain areas than we have in the past.
Absolutely. Okay, so here's a little bit of overview as to the topics that we'll cover. Really kind of highlighted from my little speech a little while ago here. Our goal here is to educate you, but then also to provide you guys with some takeaways here. What do you need to do to cover off from a compliance regulatory perspective within your day-to-day process? And hopefully what you hear from Barry from his seat is, what needs to happen from an investment perspective. And we'll go from there. This is a recorded webinar. At the end of this, we'll have the opportunity to hopefully have the opportunity to have a question and answer session. But also in the Zoom meeting here, everybody will have the ability to send a chat question in. We'll be monitoring those chats on our end. If something comes up that's topical as to what we're talking about, and we have an easy kind of break in, we'll try to answer that question. If not, we'll try to get to it at the end of the webinar here. Okay. So with that, I'd like to turn it over to Jen Krakower on our team here to walk through our phase of this presentation.
Thank you, Connor. So yes, Connor mentioned, my name is Jennifer Krakower. I'll start with going over kind of a fiduciary duty overview. So as Connor and Barry had mentioned, back in June of 2019, there was an SEC package that was released, which contained new rules and interpretations. Amongst that, which included Regulation Best Interest, Reg BI, which most of you, I'm sure, have heard that terminology thrown around, which is really the standard of conduct required of broker-dealers. With that, they also implemented the newly required Form CRS, Client Relationship Summary, which is also a newly required form of broker-dealers and investment advisors that are currently registered with the SEC, where some states are also following suit. And finally, with this release, there was also an interpretation of fiduciary duty. Now, the purpose here wasn't really to provide new rules or new interpretations, but rather was designed to reaffirm and clarify the various aspects of the duty that investment advisors owe to their clients. So fiduciary duty is broken down into two elements. First, we have the duty of loyalty, which requires that investment advisors not subordinate their client interests to their own. So in order to fulfill this duty, you have to make sure that you're providing full and fair disclosures to your clients. In addition to duty of loyalty, we also have the duty of care, which requires that advisors make a reasonable investigation into the client's interests and have reasonable belief that the advice that the advisors are providing are in the client's best interest. So now if we take the two together, duty of loyalty and duty of care, you could think of duty of care as the process, the policies and procedures implemented by the firm, the vetting, the due diligence. And duty of loyalty is seen as the outcome of these implemented policies and procedures to make sure that you're acting in your client's best interest. Every registered investment advisor owes a fiduciary duty to their clients. This is something that cannot be waived. However, and as reinforced in the interpretation, the application of fiduciary duty is generally shaped by the context, nature, and the scope of the relationship. So, for example, you have a client relationship where you are providing one-time financial planning, consulting. Your fiduciary duty applies for that limited duration of the engagement. On the other hand, you may provide ongoing investment management where your services are perpetual in nature. You're compensated an asset-based fee. Your duty to provide advice and monitoring in these cases are relatively more extensive. So now, how does this all tie together with investment due diligence? Well, investment due diligence falls into that category of duty of care, where due diligence is viewed as an investment advisor's review process or investigation to ensure that a specific product, security is in alignment with a client's strategy and their best interest. Due diligence process can generally be divided up into two processes. You have your initial due diligence phase, which is the investment selection process, where you're selecting underlying investments, managers that meet the client's objectives. We also have ongoing due diligence, which is the ongoing maintenance and monitoring in that ongoing aspect that we just talked about, where you need to ensure that the underlying securities, investments, managers continue to align with the client's overall objectives and portfolio. When conducting due diligence, many firms will choose to either do this internally or externally. So firms that conduct investment due diligence internally will either form an investment committee, an internal investment working group, or they might even have individuals at the firm that are experienced in investment research and analysis and designate these individuals as investment officers. These teams and individuals are generally tasked with analyzing investment opportunities for their firm. Now, the main issue that comes with internal due diligence is that oftentimes this becomes a check the box approach. So it's important to ensure that if you are doing this internally, that you have a thorough process in place so that it doesn't become, a check the box mechanism here. A lot of firms also choose to outsource this to an external third party. You can hire a third party to provide research, an outsourced CIO, or even appoint an independent party to become a member of a firm's investment committee. While there is a cost that generally comes with outsourcing investment due diligence, it certainly is something that is beneficial, particularly for advisors that either don't have that experience in-house, or there are more complex securities or investment opportunities that are being presented to their clients, and they don't have the capacity to do that due diligence in-house for alternative or private fund investments. Now, while outsourcing generally can save significant time and energy, one thing that we need to stress here is that that does not waive an advisor's fiduciary obligation in this process. There's still an element of due diligence and vetting that needs to be done on these outsourced providers to ensure that they have the requisite knowledge, skills in order to carry out this process, due diligence process on behalf of your firm. Now, just to quickly talk about the various investment products where due diligence extends the entire gamut, all securities products, third-party managers within a client's portfolio require that you conduct investment due diligence. Now, from a general rule of thumb, it's generally understood that the amount of due diligence that you're required to do for a particular product or third-party manager should proportionally increase with either the level of risk and complexity of those products. So for example, you have an individual stock or a straightforward ETF. Those products likely don't require as much due diligence as the recommendation of a hedge fund investment per se. So keep in mind that this is a very general rule of thumb. You can still have individual stocks or penny stocks that are, riskier than a potential derivative or an ETF. So just make sure that you take this, with a grain of salt, but understand that as the complexity and the risks involved increase, so too should the amount of due diligence. So some of the elements to consider when you're analyzing and conducting due diligence on products include looking at the investment characteristics and objectives, conducting a risk-reward analysis. What is the liquidity and volatility of the particular investment? What are your clients' liquidity needs? Conflicts of interest. Are there any conflicts with the particular investment that you're looking to recommend? How does the particular security or product compete with their competitors in the competitive landscape? How does the security align with the client's time horizon, their portfolio, and their overall strategy and objectives? What's the cost of investing? This is a big issue that the SEC is currently looking at. What's the cost of exit? And finally, performance. Performance is obviously important, but it's important to understand that performance is not the end-all be-all. As we tell most of our advisors that we work with, past performance is not indicative of future returns. So it's important to make sure that you do take this into consideration, but understand that your investment due diligence is a holistic and comprehensive approach that should take into consideration all facts and circumstances that are at play. So just to kind of go off of the items, after we've discussed what investment due diligence is and how what are the factors that should be considered. We did go through the enforcement cases and pulled out 3 pretty relevant enforcement cases as it relates to the lack of due diligence. Where this first enforcement case was particularly interesting because from our seat, it's actually very common for us to hear the regulators say during an examination, if you say you do something, you better do it. And in this first instance, the investment advisor negligently failed to perform adequate due diligence and monitoring, contrary to representations that they were making in their disclosure documents, as well as their client communications with their clients. The second instance was pretty similar as well. In this instance, the regulators quoted that they performed limited due diligence on the investment, and they inaccurately stated that they had spent a great deal of time doing due diligence on the investment strategy and credentials. And then this third case here is a case of the investment advisor really not conducting any independent basis for the advice that he was providing to his clients. This was with regards to a hedge fund that the investment advisor was recommending to his clients. He was taking everything at face value that was presented to him from performance, and that was really all that he really considered in this case. We've included links here at the bottom, and we'll end up sharing this information with you after the presentation. And should you wish to take a further deep dive into any of these cases, we will have these links available to you. So just to kind of wrap up our end here, some of the key takeaways and regulatory expectations is, first off, build a process. Make sure it's thorough, all-encompassing of the due diligence that you conduct on your firm's universe of securities or products that you utilize. And as we've learned from the enforcement cases that we just went over, if you say something, or if you say you do something, make sure you do it. Second, make sure you memorialize your due diligence in writing. Give yourself credit for what you're doing, because again, if it, from a regulatory perspective, we hear this so often: if it's not documented, it didn't happen. And finally, number 3 is make sure you have the ability to articulate and explain the investment decision-making process to a regulator. And most importantly, be able to stand and support these decisions that your firm has made. So just to kind of wrap up, our portion here, we just wanted to make reference to some of the tools and resources that we have available on Advisor Cloud to ensure that firms are meeting their fiduciary duty of care as it relates to independent manager due diligence and securities due diligence. So on Advisor Cloud 360, we do have various compliance tasks to ensure that your firm is containing the necessary documentation and backup that you need in terms of independent manager due diligence or at the security level. In addition to this, we also have a risk assessment, which takes you through different questions and answers as it relates to your due diligence process. Do you have an infrastructure in place, and helps you identify where the potential weaknesses fall within your compliance program as it relates to investment due diligence.
Great, Jennifer. So hopefully at this point, everybody understands or has a better sense as to where the SEC or regulators are looking at or coming at for this topic or these issues. Ways in which, from a compliance or regulatory perspective, what you need to be doing in-house or internally from a documentation perspective and things to look out for. When we're having these conversations, we often get the question, well, how do I actually do that? Or what does that look like from an investment perspective? And we were lucky enough to have a relationship with Barry and his firm to be able to put together this presentation and hear from an expert, an OCIO, and who knows how to do this. So with that, Barry, I'll turn it over to you and let you take it away.
Thank you very much, and thanks to everyone for joining us today. I know it's sort of a difficult time, and it's the middle of the day, so we certainly appreciate you joining us, and hopefully we'll be able to leave you with some things that will be helpful to you as you go forward in your business. If you could turn to 11. There we go. There we go, thank you. So just some general observations, some sort of takeaways that I had by reading about these clarifications that the SEC came up with. I think the first question to ask yourself is, why is due diligence important? Why are they putting some attention on this? Well, and why is it important to you to respond to what they're going to be looking more carefully at? Number one, it's going to protect you. It's going to protect your business from the wrong kind of advertising, the wrong kind of headache and heartache that you don't want to get exposed to. Number two, if you use it properly, if you go through an exercise of really memorializing your process, as Jennifer referred to, it will validate what you're already doing, or you can use it as an opportunity to improve your investment decision-making process. And lastly, if it's yours and you own it, whether you're outsourcing it or whether you do it yourself, if you really own the process in your own mind and what you're doing and why you're doing it, my experience in working with advisory practices is that you can use that knowledge in your client interactions to build confidence in your clients so that it can help you grow your business. As a general matter, if you think about this in this whole area, it's common sense to believe that any SEC regulator, when he comes in to examine an advisor's practice, is going to ask themselves the question, does what this advisor do, does what he do or she does it make sense? Because they're talking to their colleagues and they have past exam experience, and so they have some experience to draw on. And therefore, it's important to realize, even though there isn't an explicit standard, as there is, let's say, with the Department of Labor, they are going to be drawing upon their experience with other advisors to ask the question, is what they're doing, does it make sense, is it complete? So whatever you decide your process is going to be, whether you insource it or outsource it, however you do that, or some combination, some hybrid, you have to figure that it's got to pass this test, at least. Some examiner is going to look at what you're doing from beginning to end and ask the question, does it make sense? And this is a top exam priority for 2020, so the key takeaway is be prepared for heightened scrutiny. Now, the one thing that's I think is really important to understand, having been in this business, this part of the business for 30 years, is to understand that the SEC's guidance is intentionally vague and open-ended because they want to give advisors flexibility. That's completely different than the Department of Labor. The Department of Labor is very explicit. They have do's, they have don'ts, they have frequencies that you have to do things so that they're forcing the trustees of qualified plans to do certain things to protect retirement plan assets or health and welfare assets. That's not the case with the SEC. There are no due diligence do's or don'ts per se. They don't provide a checklist of documents or processes they expect to see. It's all open-ended. They have no preference on what investment instruments you use to invest, but if there's no paper trail, if you can't articulate what you do and it doesn't make sense in comparison to what they think the industry is doing, I think you've got a problem. So you should decide for yourself your own do's and don'ts and document that you follow through on those do's and don'ts, not once a year, but on a regular enough basis, because investments change, organizations change, people leave, people get sick, people sell their interest. And keeping track of all of that is important to reiterate something Jennifer said, is to make sure that your investment thesis on an investment still stands up over a holding period. But rather than just, as Jennifer said, just filling a file or checking the box or crossing the T's or dotting the I's, I think you should use this to leverage your time and use the work product of this effort, which you're going to put into this, to differentiate yourself in the marketplace and enhance the marketing of your firm. Make yourself different, and if you're speaking with confidence about your product, your prospects and clients will really get it, and they'll feel that confidence and will make it more comfortable for them to refer you business. Next page, please. So, because the SEC is intentionally vague and it's all open-ended, I think you have to consider the sort of full range of investment process considerations when you're thinking about putting yours in place. That means you should be thinking about the capital market assumptions that you're using in your financial planning software. I think it means you have to look at your investment guidelines that are used to structure portfolios. I think you have to look at how you diversify portfolios and the process you use in diversification. I think you need to consider how products are selected, what attributes you're looking for, how you assemble portfolios, what's the process for combining products into a portfolio, and then what is product due diligence on an ongoing basis. So let's get into each one of these things in a little bit more detail so that I leave you with some takeaways and hopefully some useful things you can use to start the thinking process about this. Well, capital market assumptions are the critical inputs that are used for long-term asset allocation advice in financial plans. They represent the return, the risk, and the correlation forecasts for the asset classes that you are permitting in your client accounts. They help determine the outcomes you're forecasting in your plan for diversified portfolios that support your asset allocation and decision. And what I'm about to tell you is the key thing, and I've been doing this for 30 years with advisors. The expectations you build into your capital market assumptions. When you say to a client, here's what the forecasted rate of return is, and let's say you use a number of 8% or 9% or whatever the number is, you may hedge that expectation as much as you want in a financial plan. But I'm here to tell you what the client is going to remember and what their expectations are going to be built around is going to be the number you give them, the return expectation. They're not going to be thinking about risk. They're not going to be thinking about correlations. They're going to be thinking about the return. And they may not overtly interpret it as a guarantee, but that's the number that they're going to anchor emotionally around. So it's very important to put time and effort into getting capital market assumptions that make sense, that are reasonable, that help shape your client's expectation, and not only their expectation for the return on a portfolio, but how that return might need to be dovetailed with things like asset allocation and savings rates and time horizons. So getting the capital market assumptions, I think, built into your process is really important. And these expectations require periodic updates because the world changes. The economy goes south, the economy goes north, the economy has a V-shaped recovery, a U-shaped recovery, or whatever it would happen to be. And just remember, it's important to remember that these capital market assumptions are forward-looking. And so if we'll turn the next page, what I want to do is I want to go through how you can come up with capital market assumptions. There's more than one way to do it, and anybody in the business who does capital market assumptions commercially will tell you no one is ever right. But you have a fiduciary obligation because you're investing in the future and into the future. You have an obligation to have some sort of a estimate, some sort of a world view on what the investment world might look like in the period going forward that you're investing into for your clients. There are several ways at a bare minimum that you might go about this approach. It doesn't matter which approach you use exactly, but make sure whatever approach you decide to use, write it down. Be sure you're comfortable with that approach and you can explain it, and that the numbers it generates make sense to you. And you should be reviewing them, I would say, at least on an annual basis, so that enough time is elapsed between the last time you did your capital market assumptions and enough change might have occurred for you to modify your capital market assumptions. It doesn't mean you have to, but it means you review them on a regular basis and you either change them or you approve them in writing that you can continue with them for the next year. So what are a few simple ways of getting to capital market assumptions? Well, number one is financial planning software is going to come with embedded capital market assumptions. If you're going to use those, understand what the embedded method of capital market assumption forecasting is in the software. Understand what they say they do, whether it's historical or whether it's forecasted in some way. It's really important to understand what the method is and make sure you agree with it, because you're going to have to defend it potentially. Because remember, your capital market assumptions are going to feed into what the forecasted or expected return is on an asset allocation strategy, and your client's going to anchor around that number. So make sure you can defend that process that comes with the software. On the other hand, if you have the flexibility in your software to enter your own capital market assumptions, you might want to try triangulating capital market assumptions by getting numbers from several reputable sources and sort of average them out and see if you can come up with something from reliable sources that sort of achieves a consensus. That would be another way of doing it. And thirdly, you might want to go to a reputable provider who's in the business of providing capital market assumptions on an independent basis. Next page. The next step, so if the first step is the inputs to investment returns for the long run, then the next thing is what's the playing field? What are the ground rules that you're going to use to construct portfolios? These are called investment guidelines. If you look at a prospectus for a mutual fund, there will be a section which covers what investments are permitted in a mutual fund. And if you look at a manager questionnaire that's completed for a separate account, RFP, you'll note for sure that the manager says, here are our investment guidelines. We don't have more than so much in this sector, or our minimum expected purchase of a stock is at 1% or 50 basis points, or whatever it would happen to be. They have rules for assembling client assets into portfolios. And even though a money manager is also an RIA and they have their own version of guidelines, you guys are RIAs and you should have your own form of investment guidelines as well. And again, they represent the rules for how you can assemble portfolios, sort of the playing field that you're going to work in. It helps, and because you work within a playing field which you define, it's going to help you develop a more consistent investment brand experience across your clientele. There's no universal set of guidelines that apply to every advisor. There are lots of different ways of doing it. Lots of things make sense. You should determine that for yourself. But be careful that the guidelines you use are not so broad that you really don't have guidelines. If your guidelines are, I can have a 0 to 100% in every asset class, that's not really a guideline. So make sure that guidelines make sense, and make sure also that they're not so restrictive that you can't make changes to the portfolio. Because remember, these are going to be the written rules of the road for putting portfolios together. Whatever your guidelines are, write them down. And your guidelines should or could potentially address the following sorts of questions. What asset classes are you going to permit in client portfolios? Which of those asset classes are strategic and always in a portfolio? They have a sort of a permanent place in a portfolio. Which ones are tactical? It can go in or out depending on market and economic conditions or something that may change with the client. What performance benchmarks are you going to use to measure whether the different asset allocation strategies you're going to use? What are the minimum and maximum exposure limits for different asset classes for both tactical and strategic? Are there any prohibited investments? Do you have any position limits for a ticker symbol or for an individual security? Or do you have a position limit for putting too much money with one firm in a client's portfolio? What are your style diversification requirements? What sort of risk management controls do you want to have? You could use something like beta, or you could use something like tracking error relative to a performance benchmark to gauge how much performance variability you're willing to have that goes outside of the strict performance of the index. Will you allow any illiquid assets? If so, what are the conditions? How much can be in a portfolio? And you allow any non-traditional investments? Addressing these issues, even if it's to say we don't allow illiquid assets or we don't permit non-traditional investment strategies. Comments like that are definitive. They can be in an investment guideline. So the point is to create the playing field that you're willing to operate in. And then, going to the next page, we get to the area that an examiner might be looking at, and that's asset allocation. How do you do the asset allocation? How do you achieve diversification? Because that diversification has got to work within the guidelines you just set in the previous page. And there are alternate ways to accomplish this. There's no single way to do asset allocation all the time. You can try multiple ways. You want to use one method for certain types of situations and another method for different types of situations. But whatever method or methods you use, write them down and determine which methods you use for which types of situations and when they're applied. The main point I make here is no matter what method or methodologies you use, the final choice of asset allocation is a professional judgment. You cannot say the technology made me do it. The computer did it. It's the computer's fault. It's the program's fault. You're only using technology to help you ask questions and get synthetic answers, digital ideas to go on, but the final call is ultimately yours. Now, there are a number of different ways, and I probably haven't listed all of them. Of course, there's the traditional Markowitz mean variance optimization, which gets you the maximum expected return for a given amount of risk. Then you've got postmodern portfolio theory optimization, which has some similarities, but instead of maximum risk for return, excuse me, the benchmark of performance for a portfolio is you don't want to have a negative return at all. So usually it's what's the portfolio I need to put together to get no worse than a 0% rate of return. Monte Carlo simulations, I think we're all probably familiar with those. Asset liability modeling, which takes a look at basically puts a portfolio together based upon the term structure of the liabilities. So really long-term liabilities, 20, 30 years, can have more equity-oriented investments, and short-term liabilities would tend to have more fixed income-oriented investments where less risk can be taken, and that's how you would achieve a asset allocation using asset liability modeling. You could also have benchmark-specific allocation where you say, as an example, the investment world that I live in is basically all of the equities, publicly traded equities in the world, which essentially is represented by the MSCI All Country World Index. And for all intents and purposes, it's about 55% US and about 45% international, both developed and emerging market. And so the question is, if you're going to use that distribution in an equity portfolio as a starting point, how much variance are you going to allow yourself to have? Are you going to always have some international, or are you going to allow that to go to zero? Are you going to always have domestic? What's the minimum exposure you can have? What's the maximum exposure you can have? That's another way of achieving an asset allocation strategy. And lastly, and sometimes my favorite, and probably the one I repeat the most often, is the rule of thumb method, which I heard many years ago by a grizzled old veteran in the industry who said, you should have 10% in fixed, your client should have 10% in fixed income for every decade they're alive. So a 60-year-old would have a 40-60 portfolio, typically to minimize the chances for a loss. But obviously that 40-60 rule could be modified based upon cash flow and wealth and contingent assets that might be pouring into the estate. But it's at least a starting point, and you can make adjustments from there. Next page. Now we're going to go to product due diligence that Jennifer talked about. We divide, we're a research firm, and we do due diligence on investment products for our clients, both RIAs and banks and trust companies and multifamily offices. We divide investment due diligence into two phases. There's a selection phase and an ongoing due diligence phase. They're both elements of what the SEC means when they refer to extensive research on investments. It's not just deciding you want to invest in a good product day one and then sort of forgetting it and hoping that everything works for the best. What's the purpose of due diligence? It's to make sure, basically, that the investment that you made is a viable option for the investment objectives and client circumstances that you're presented with given prevailing economic and market conditions. But investment product selection is not really isolated. You don't pick products in the abstract. They have to be selected because they're going to fit into a portfolio with either ETFs or individual securities or cash or private partnerships or something else. And so it's important to understand that the context for picking a product is the portfolio. It's part of the team that you're building to institute a portfolio strategy. And so when you're picking a product, you want to explore the organizational issues, the stylistic issues, the fundamental characteristics of that individual product. And what performance attribution factors are you looking for? What sort of strengths are you looking for in that manager? The answer to these questions, if you get those answers, dramatically narrow the search field to ones that truly meet your specifications. So if you go to the graphic on the next page, this is an example of our firm's approach to selecting products, the most important step of which is all the way on the left. It's to establish what you are looking for. The more specific you can get in what you're looking for using the kinds of characteristics I illustrated on the previous page, the narrower the field will be to begin with. and you won't be picking a needle in a haystack. You'll have a relatively modest-sized list you can look at, and then you can literally eyeball the surviving candidates and eliminate some for very obvious reasons, like a very high expense ratio, or it's too small a fund, or I already have too much money with that firm, or any of a number of sorts of things like that. The firm had a bad legal problem and they were in the press recently. I don't think that'd be good for my brand. I don't want my clients asking about that. So there are ways of limiting that just by eyeballing the surviving managers after you have, I should say products, after you have done the really specific search screening that you want. Next page. So it's fun. Let's admit it. It's fun to pick a product. It's something new. It's something exciting. It's a fresh track record. It's a fresh idea, and hopefully it will add incremental value to the portfolio you put for your client together for your clients. But that's not enough. The purpose of the second phase of due diligence is to be sufficiently certain on an ongoing basis and comfortable that the advice you gave your client about a product you can reconfirm. And essentially, you have to revalidate your original investment thesis and the continued advisability of using a strategy or a product in client portfolios. Given where you want the overall asset allocation in the client's portfolio to be, do you want to use this kind of product? Do you want to assign the same sort of weight to this product that you did previously? Has there been sufficient organizational stability to make you confident and comfortable in the organization that is managing this process? Have you noticed any change in philosophy that the manager is exhibiting? You can tell some of that by simply looking at the performance. And if the performance is not what you expect, then either you didn't get the philosophy right or something has changed and it's worth exploring. Has there been a material change in the investment process? Again, looking at things like volatility and beta and tracking error and all these performance statistics can give you clues that something is going on that you didn't bargain for when you originally invested in that product. The performance should be more or less in line with your expectations. If you're investing in a product with low tracking error and the market goes down, you should expect that the product will go down in value. If the market goes up and it's a low tracking error product, the product should go up in value, and the variance from the performance of the market will be dependent on how much variance you've allowed through the choice of that product. And of course, keeping track of what the manager owns and doesn't own to make sure they're sticking with their own guidelines is important as well. And you need to look at holdings to be able to do that. At the end of the day, ongoing due diligence should reveal the relative degree of consistency of the manager executing an investment process. It should take the temperature for organizational stability to support the process that you invested in, and it should have a relative degree of investment success in comparison to peers and in comparison to a benchmark. It doesn't have to be the best. It has to be consistent, it has to be stable, and there has to be a relative degree of success. Trying to always pick the top performing manager is just not an effort that's worthwhile because it changes too much. So let's go on to the next page and talk about our own process for doing due diligence. This is the companion process that we use when we're doing quarterly due diligence on the products we cover on behalf of clients. So it's a detailed process that essentially is a revalidation of what we did in the first place. We have a lot of information already, but we want to make sure that we look at the performance analytics, we talk to the manager, we read what the manager is saying, we do detailed decomposition of the performance so we understand where the returns came from, and then we're comfortable that the manager, this still makes sense, it's exactly what we intended, and either the style is in favor or it's out of favor. We're not going to penalize a manager because they're underperforming because the style that they're in is underperforming. We just want to know how they're doing in comparison to their peers who manage money in the same way. So let's go on to the next page, and we'll talk about how to assemble all of these products that you've selected. At the end of the day, when you're putting together a portfolio and you're trying to achieve a forecasted capital market assumption out there, 5 or 6 or 10 years or even longer. Essentially what you're trying to do is you're trying to build a portfolio that has the kind of behavioral attributes that you want, not too much risk, not too little risk. And at the same time, it gives you the economic exposures you deem are appropriate or favorable given what's going on in the world and given who your client is. Essentially, you're taking these products and you're assembling a team to diversify or concentrate exposures and opportunities. You should have this construction, the choice of tickers, the weights, the allocations you're going to assign to those managers. You should approve that formally at an investment committee meeting and have some sort of written notation that it's been approved. Or if you're doing it by yourself, you should still document that, that you did it and you approved it on a certain date. The one thing I would want to emphasize is, and this is harder than it is easier, is to make sure that you are comfortable with what the construction of the portfolio is. As you see these pie charts, you can see what's in the portfolio. Make sure that it comports with what you're intending to build for the client. Sometimes, particularly in mutual funds, this is not a fault of mutual funds or separate accounts, the actual inner workings of the portfolio and the holdings in the portfolio are not exactly they're not exactly the same as the advertising or the name on the outside or the wrapper or the prospectus would have you to believe. So you could have a large cap product that has a fair amount of mid cap. If you're going to be doing asset allocation, you would want to take that mid cap exposure inside the large cap product into account when you're deciding how much you want to allocate to mid cap. So we'll go on to the next page. And here's an example of how you can do some sort of back testing on portfolio construction. So if on the right-hand side, this is by looking at the holdings inside. This happens to be an ESG equity sleeve that we're building for a client. And you can see that the benchmark is very core. It's right in the middle, and it's sort of mega cap. And one thing, you can see the comparison between the proposed ESG model sleeve and the MSCI All Country World. You can see that the MSCI All Country World is more value oriented, and the ESG portfolio naturally is more growth oriented because of the nature of the companies that make up ESG portfolios. And you can see there's an overweight to mid cap. A lot of the ESG companies are mid cap. They're not super large yet. They're getting there though. So the point is understanding that what you're building is what you intend is important in the portfolio construction area. And from a behavioral point of view, if you go to the next page, if you're trying to build a portfolio that has a beta or a volatility in comparison to the benchmark, if that's what
I can't hear anything.
Barry, did we happen to lose you? All right, sounds as though we have lost Barry. At this point, what we can do here, I think there was only 2 or 3 more, one more slide maybe that Barry was going to cover off on. What we can do is obviously we'll open it up at this point to any questions that anybody has. As always, we'll be sending, as I said at the top of the call here, we're going to be sending out an email with the recording here as well as the presentation. Both of our contacts, Jennifer and my contact, will be available if you have any questions on for us. But we'll also include the contact information for Barry if anybody has any questions to follow up on his portion of the presentation here. So with that, certainly, we'll open it up if anybody has any questions. From the chats, we'll just go right off the top. We have one chat as it relates to recommended timing in which the due diligence or the reviews should happen, whether it's quarterly or annually, both from a regulatory perspective, but also on a best best practice perspective, I think what we heard from both Jennifer and Barry is the SEC doesn't have any prescribed rule on how this absolutely needs to have how it needs to be done and when it needs to be done. As always, what you'll hear from AdvisorAssist is that you have to have a reasonable basis to perform this information. Now that could, or this task, this could be done, you could determine that, once a year is good enough for our process. We've got documentation to support that and evidence that we can, have the conviction around that process. Others that may have a more thorough investment process, whether it be various investment products or models or portfolios that they're managing, they might need to take a more regular look at it. It might be quarterly. It might be a monthly process if your firm's large enough and you want to have an investment committee in place. So really the determination on what needs to happen really is at your doorstep. You have the decision to make. The SEC isn't mandating anything. They just are mandating that something does need to happen. So hopefully that answers the one question we got in, and if anybody else was thinking about that process. Other questions that we received here is documentation that you need to have from an outside, perspective, right, on the actual investments. What type of documentation do you need? Is it fund prospectus? Is it offering memorandums and private placement documents? Really, it's anything that you guys, have access to that shapes your decisions as it relates to the construction model and the inclusion of a particular security or holding. Right. Again, as I said, the SEC isn't, or any state regulator, they're not mandating that you have to have a file that has a prospectus, a fact sheet, or offering memorandum, or a tear sheet off a Morningstar. It really is what you have access to. Could be third-party manager research that you have access to that you're going to utilize to shape your decisions that you're making. But if we go back to what you heard throughout this process, it really is your determination and what makes the most sense for you guys. With that, we just got a chat from Barry. He's back in. Barry, I'm just going through some of the open questions that we got through chatter. At this point, I'll open it up to see if anybody has any questions. Feel free to unmute yourself, and we'll take it from there. Okay. Barry, we got one question in here. What are our thoughts on allocation based on market momentum? If you want to take that. Barry, you with us? Okay. All right. Well, Barry's not with us. Certainly would like to have Barry's thoughts on that. So we'll respond to this individual with that and get you guys in touch if that makes sense. One other question we received here is, where do we find due diligence suggestions on alternative investments? Again, I think from our slide deck, what you'll see there is, that is one of the, from a regulator's perspective, that is one of the most highest level of risk area or due diligence absolutely should be should occur. The thoroughness is pretty strict and it should be stringent. What should you use? Again, it's your offering documents. Having conversations with the investment managers, the GPs that are maintaining and managing that fund, understanding what their investment process is. If it's a fund of another fund, there's a cascading effect that needs to happen. The SEC, for exams that we've been through where, the level of due diligence really stayed at the top level and there wasn't really a drill down to a fund's underlying holdings. So there certainly is a requirement, at least in the eyes of the regulator, that we are, expecting some sort of due diligence on underlying holdings. There has to be a documentation in process or in place. It can't just be, oh, I had a call with the investment manager or the GP for this fund. We talked about X, Y, and Z. It was on this date, and it, really didn't show a full, story or process that to substantiate that you have a dedicated process. So we should be able to show the thoroughness that needs to take place there. Barry, are you with us? Okay.
Yes, can you hear me?
We can now.
Great. Terrific. So the question I began answering before was about momentum. The answer is, depending on how focused you want to be on momentum and the momentum factor, if you're doing some sort of factor-based investing and momentum is one of the factors you're using, then you should just make sure that in your investment guideline that you permit factor investing, and you can decide what minimum and maximum factor exposure weights you want to assign to things like momentum. And obviously in a broadly diversified portfolio, even like an S&P 500 ETF, you're going to be capturing momentum. It's just capturing a lot of other exposures as well beyond the momentum. So the effect of the momentum is muted, but you're still going to pick up some of it. So as long as it's in your investment guidelines, then it works just fine.
Great. Another question that we got here, we have a couple more minutes to the top of the hour. The question that we got here is with regard to due diligence on structured notes. We've been working pretty closely with a third-party structured note provider over the last couple of months here, and been in discussions with them about their process, where RIAs need to be thinking about and looking at as it relates to the recommendation or execution of a structured product or a structured note for their clients. What we hear is understanding where the provider is, what relationships that they have with the various issuers out there, making sure that cost is always a concern, and understanding from an execution perspective, from a trading perspective, where we are in terms of the cost. What the interplay is between the issuer, who's doing the structured note trading for you, and understanding truly, is there a thorough best execution fiduciary duty that's happening for your clients. So please, what we would stress here is finding the partners that are specialists in areas as it relates to structured notes or derivative type trading, that really show value to you, to your clients, and are willing to work with you and the third party issuers to make sure that cost isn't something that your clients are getting hammered on from their end. Doing that, what we understand to be is will show value to your clients and the relationships that you as RIAs will bring to your recommendations in that area. Okay. So, I'd like to close it at this point. The slide here has all of our contact information. As I said earlier, we will certainly provide this recording out along with the slide presentation here. If anybody has any questions on the regulatory operational front, certainly reach out to myself or Jennifer. Any questions as it relates to the investment process. I'm sure Barry would be willing to speak to you on that process and discuss those going forward. So at this time, I'd like to thank everybody for joining, particularly Barry, and providing your valuable expertise to all of us. I know Jennifer and myself, through our conversations, we've learned a lot through this process. It's kind of helping us, mold what we do and how we communicate the regulatory front to our clients. So thank you very much for that.
Thank you.
All right. Well, thank you again, everybody, and we'll be timely in a response here as it relates to the presentation. And thank you again.